Hi everyone, this is Cherry Chen from the Real Estate Tax Tips channel. A lot of my clients are real estate investors, real estate agents, contractors, and simply, hardworking Canadians. And they often come to me and ask me for tax advice. One of the most asked questions is if they should set up a corporation and if they should pay themselves salary or dividend. So today I'm going to use this opportunity to go through in depth in terms of whether someone should pay themselves from their corporation a salary or a dividend. I think it's the best to go through an actual example. Let's just start with some facts and assumptions. So let's assume that the company that you own net about $200,000 before paying yourself personally. So it could gross $5 million after all the expenses before paying yourself. You net about $200,000. Now is in this crossroad whether you should pay yourself dividend or salary. Now, you need about $100,000 worth of net after-tax cash available for you to sustain your personal life. So with that cap in mind, we can look at the example. On the left-hand side, you can see that if you were to pay yourself dividend, the company profit net after paying all the expenses, deducting all the expenses, is $200,000. The corporation tax, if it is $200,000 and a qualified small business is entitled to the small business deduction rate, and which in Ontario is 12.2%. So by paying 12.2%, which is equivalent to $24,400 of tax, you have net profit of $175,600 left in the corporation. Now you notice that you haven't paid yourself a dividend yet. With dividend, you pay the corporation tax, then you pay yourself the dividend. So now you are net with $175,000. Then you decide to pay yourself a dividend. In order to sustain your life of about $100,000, you have to pay personal income tax as well. So you have to pad it up with the amount of personal income tax that you have to pay, account for it. So after the calculation, we notice that you need to pay yourself at least $126,500 to cover off the personal income tax of $26,000, and then you will end up having net amount of $100,000. Now, this is dividend. So to recap, dividend means that the company earns a profit, pays the income tax on the corporation income tax first, and whatever that's left over, you would then be eligible to claim and pay yourself, the shareholder, an amount of dividend. And when you pay yourself the dividend, you have to also account for the personal income tax that you would otherwise have to pay on the dividend amount that you receive to come up with the net amount that you require for your personal need. Now, in terms of salary, if you, under the same scenario, the company's profit before paying the salary is $200,000. To come up with the same amount of net after-tax cash available to sustain this person's personal life, the corporation would need to pay a salary of $147,400 to the individual. And on top of that $147,400, the corporation also has to pay about $3,500, the employer portion of Canada Pension Plan. When you pay a salary, you need to contribute, you're forced by the government to contribute to the Canadian Pension Plan. You don't have a choice, you have to pay it. So the maximum amount for contribution is $3,500. And when you pay a salary of $147,000, you would max out the employer portion of CPP. Now, after paying yourself the salary, contributing to the employer portion of CPP, you are now net with $49,000 left in the corporation to pay 12.2% tax. Now, the 12.2% corporation tax is equivalent to about $5,990. And so after paying the salary, after paying the CPP, after paying the corporation income tax, you are left with $43,000 inside the corporation. This amount is still sitting in your corporation bank account after you pay all these taxes. Now, on the personal side, when you receive the salary, you need to also contribute your portion of CPP. what do you really mean? Well, what it means is that when you pay yourself a salary, you're considered an employee of your own company. You're an employee, and when you're an employee, you are also required to contribute to CPP. The Canadian government just required you to contribute a portion of the money into CPP, and the maximum amount in 2022 is $3,500. So you need to deduct that $3,500 from your pay. And then you also pay personal income tax as well. And personal income tax is on $147,400 income is about $44,000. So at the end of the day, after tax cash available, after you contribute the employee portion of CPP, after you pay your personal income tax, you're net with the $100,000 that we talked about that you need to sustain your personal life. Now, as you can see, the salary is purely being taxed in your personal name. The amount of salary that you pay to yourself, your corporation pay to you, is being taxed in your personal side, and that full amount is being taxed in your personal name based on the marginal tax rate that every Canadian is subject to. So in this particular case, it is subject to roughly $44,000 of personal income tax. The combine of the salary you pay to yourself together with the employer portion of CPP, they're considered deduction to the company. And therefore, you don't have to pay the 12.2% on the amount that you pay to yourself. You only pay corporation income tax on the net after amount, net income after paying owner's compensation. So when you pay yourself a salary, the sequence of event happens, you earn the profit in your corporation, you pay yourself a salary, the net amount is what's subject to the corporation tax. And the salary, when it's being deducted and not being taxed in the corporation, it has to be taxed somewhere. Under the salary scenario, it's being taxed in the personal income tax, personal side, and you have to pay the progressive tax rate on $147,000 that you receive. So from this two scenario, you can see corporation first pay its own tax, and then on the dividend amount that you pull out, you still have to pay a lower amount of personal income tax. You still have to pay some, but it's not as high as if you were to pay under salary. On the salary side, the company doesn't have to pay tax on the salary or on the amount that you're pulling out. The salary that you're pulling out is a deduction. You pay full tax on the amounts that you are taking out. The salary is the amount that you're being added to, that's being added to your personal income tax. Now, so what's more advantageous? As you can see in front of you, look at the lines highlighted in yellow. Two ways to look at it. The after-tax cash available if you were to pay yourself a dividend. We assume that the after-tax cash available in the corporation is the only thing that's left, because at the beginning of our example, we made the assumption that you need $100,000 to sustain your lifestyle. And so after-tax cash available in the corporation is the only after-tax cash is available for saving or investment. So this after-tax cash available in the corporation, if you pay yourself dividend, is about $49,100. And the same amount after-tax cash available in the corporation, if you were to pay yourself a salary, it's only $43,000. So there is about $6,000 difference between the two. So if you want to net most to your corporation for reinvestment, it seems like dividend is the way to go, because you actually net more money under the dividend regime rather than the salary. Now, if you look at the total tax pay, when I say total tax pay, it means the personal income tax and then also the corporation tax that's being paid. You look at the dividend side, the combine of the personal income tax as well as the corporation tax, the $26,000 plus the $24,000, it works out to be about $51,000 that it's being charged on the dividend side. On the other hand, on the salary side, the combine of the personal income tax as well as the corporation income tax is only $49,798, so roughly about $50,000. So this is when you can come down and see that, hey, like they are more or less the same amount within a few $100s. Under dividend, the total tax pay is $50,864. Under salary is roughly about $49,800. So there is about $1,000 difference. But you may wonder, like, so we're paying more tax under dividend regime, but salary side, we're paying less tax. How come it's more beneficial to pay yourself a dividend as compared to salary? The difference really comes in with the CPP. because CPP is actually a tax deductible expense in the salary side and also a deductible expense on the personal income side. So under both situations, the main delta in terms of cash flow is the contribution to the employer and employee contribution to Canada Pension Plan. If you pay yourself a salary, you are required to contribute both the employer portion and employee portion of CPP. I know you're self-employed, but the corporation is considered employer and you yourself is considered an employee, and therefore you need to pay CPP. If you're self-employed as a sole proprietorship, no corporation involved, this CPP contribution amount, employer and employee portion, often being calculated as part of your personal income tax return. So you have to pay for this amount. If you pay yourself salary, the major delta is really the CPP employer and employee contribution. So you net less money if you pay yourself a salary, even though you pay less tax. Hey there, sorry to interrupt the video. I know you're learning something valuable and I love sharing strategies to build wealth and achieve financial freedom with you. But if you want to learn even more wealth building strategies from top experts like Derek Foster, Jesse Itzler, and if you want to achieve financial freedom faster so you can finally live your best life, then I highly recommend that you save your seat at the upcoming Wealth Hacker Conference that's happening on November 12th, Saturday, 2022, live in Toronto. Whether you are a real estate or stocks geek like me, or you are a crypto head, or even a business owner or aspiring entrepreneur, grab your tickets now because we'll be sharing all the best practices for building wealth across these asset class at the Wealth Hacker Conference. Come November 12th, live and in person in Toronto. Now that we have gone through a detailed example on how dividend works in real life with the assumption that you need to net about $100,000 in your personal name, and we also go through a similar example with the similar objective of netting the same $100,000 in your personal name under the salary scenario, we all get a better understanding of how each strategy works. And now it's the time to go through the different attributes of dividend versus salary so then you can make the best decision for yourself. So dividend and salary, we learned from our previous example, the first difference is the tax, the way it's being taxed. You can see that under dividend, you pay both corporation tax and a lesser amount in personal income tax because the Canadian tax system is designed in a way that would account for the extra tax that you already pay in the corporation when it comes down to paying yourself a personal dividend. The salary, that you don't pay any income tax on salary side. In the corporation, you pay the personal income tax on the entire salary amount. That's the first difference. The second difference between dividend versus salary is the CPP contribution. As illustrated earlier in the example, you could see that there is an additional $3,500 being contributed by the employer and then another $3,500 being contributed by the taxpayer, so a total of $7,000 being forced by the government to put aside for your future retirement plan. So then when you get to the age of 60 and say 65, you would be able to collect the CPP amount from the government. That is a second difference because that's additional on top of what you would otherwise need to pay for dividend under the dividend strategy. Now, the third difference is the RSP contribution limit, which we didn't cover in the example. So if you are interested in generating or building your RSP for portfolio, the Registered Retirement Saving Plan portfolio, in Canada, you need to earn salary to create that RSP contribution room. So the RSP contribution room, the maximum that you can contribute to your RSP plan is purely generated and calculated based on the amount of earned income that you received. And dividend is not considered the earned income, while salary is. So if you pay yourself salary, you would then be allocate a portion, 18% of earned income, up to a maximum amount, and you would take that amount and make contribution to RSP, and it allows you to deduct taxes on the personal income tax side, and the amount of money that you invested through your RSP can grow tax-free in a tax-free environment until the year that you take the money out. Now, on the flip side, dividends doesn't allow you to create any contribution room. If you don't have any RSP contribution room to begin with, you want to create some, you don't have a choice but to pay yourself a salary. The fourth difference between salary versus dividend. Salary gives you a small amount of additional tax credit. It's about just over $1,000 Canadian employment tax credit that's available. It's some amount of tax saving, but it's not substantial amount of tax saving. In our early example, we already accounted for the Canada employment amount. But if you pay yourself dividend, you do not qualify for that Canada employment tax credit. The fifth difference is childcare deduction. So childcare deduction can only be claimed against earned income. And again, similar to RSP contribution, definition for the earned income with the childcare deduction is that dividend is excluded and salary is included. So in other words, if you have young child, if you incur daycare expenses, nanny expenses for about $8,000, up to a maximum of $8,000 for children under the age of 5, you could claim up to $8,000 and get it offset, and so you don't have to pay tax on the $8,000, and you can claim the childcare expense as a tax deduction. Now, those tax deduction is not eligible unless you pay yourself a salary. So if you don't have that earned income reported in your personal name, you cannot claim those deductions and save yourself taxes. If you pay yourself the same amount of dividend, you just lose out on the deduction. So more often than not, we often advise our clients, make sure you pay yourself a salary to max out the deduction. And don't lose out on the deduction because they are qualified deduction that you should be claiming because you pay the childcare expenses no matter what. So those are the consideration. If you have childcare, young children between the age of 0 to 5, you should pay yourself some salary. Anyone that had children over the age of 5 to 16, you are still qualified to claim some amount up to $5,000 each year. And that's what you would have to do. Pay yourself salary if you have children and you also incur childcare expense or summer camp expense. The sixth difference between the two, dividend versus salary, is the filing. The filing obligation is substantially different between dividend versus salary. Dividend is super easy. All you need to do is to pay yourself a dividend, just write a check to yourself from your corporation to yourself, mark it down as dividend. You tally up all the dividend that you pay to yourself at the end of the year. When I say at the end of the year, is at the end of the calendar year. And by February 28th, you would have to file a return called T5 information return. Essentially, it's an information return to tell the government that the corporation has issued this much money to the individual taxpayer in the form of a dividend. And then you get to report that, take that T5 and report it on your personal income tax return. If you pay yourself a substantial amount of dividend, chances are you would also be triggering some personal income tax installment obligation. So throughout the year, if you pay yourself dividend, you need to set aside some amount of money on the side to pay CRA. The filing obligation on the salary side is a lot more complicated. On the salary side, you have to register first with CRA to become an employer, and we register them and have a payroll account. We often help our clients to register them at their payroll account. And once the payroll account is set up, then you have to, every time you pay yourself a salary or your staff a salary, on a monthly basis, you have to deduct the CPP, the employee portion of CPP against their pay. You have to withhold the tax that they would otherwise need to pay on their personal side. And then you would also need to add on the employer portion of the CPP into the mix, and then send that total amount to CRA on the 15th of the following month. So it's a monthly obligation that you need to send these source deductions to CRA. If you don't send the money, or if you send the money late, you're screwed. They would charge you heavy interest and penalty on the amount outstanding. You never screw anyone's source deduction. This is the reason why a lot of our clients choose to pay themselves dividend for the easiness of the filing obligation. Now, on top of the monthly source deduction withholding and submission to CRA, you also need to file something called a T4 information tax return, which is due in the following year, again, calendar year, on the 28th of February. Now, the reason why you need to do that information return and submit it to CLA is because CLA needs you to do a reconciliation to tell them how much you pay to employee A, employee B, and yourself, the 3 employees of the corporation, how the tax is being broken down, because every month you only send them a lump sum amounts. They don't know how it's being taxed, how it's being allocated among employees, and what portion is being allocated to CPP, what portion is being allocated to EI, and what portion is being allocated to personal income tax withholding. So all these have to be reconciled to CLA, and the T4 summary return is essentially the reconciliation you're providing to CLA. So that is also a filing obligation at the end of the second month at the end of the year. So salary versus dividend, and other significant difference is that your corporation can claim to pay a salary and take a deduction. Remember our earlier example, salary, the way it's being taxed, your corporation earned a net profit before paying yourself, you deduct the salary, you don't pay corporation tax on the salary that's being paid to you personally. So salary deduction typically can be accrued. It doesn't have to be paid immediately, but it could be accrued in the corporation tax side. And if you don't want to pay as much corporation tax, you could pay yourself that salary. And when you pay yourself that salary, accrue that salary, you have about 6 months to pay yourself, actually declare and take the money out from the corporation. So this timing differences work in the taxpayer's favor, and the person, the corporation, would be able to defer a large amount of taxes not to be paid until like 6 months later. So that is a strategy that a lot of accountants are using to accrue the salary and then later pay the salary out to the personal side and then pay the personal income tax later on. Now the if difference is that salary has to be reasonable to be eligible for deduction. If you choose to pay your son $500,000, an adult son, and he doesn't work for you at all, you can't technically pay him $500,000. Maybe he only does landscaping work for you and really worth $50 an hour, and maybe you need to pay him $500 instead of $500,000. You cannot claim it as a salary. Dividend, however, does not need to be reasonable. Now, if you're paying your son, it still has to be reasonable, unfortunately, unless they put in certain amounts and certain requirement. But dividend does not necessarily need to be reasonable. Salary has to be reasonable to qualify for the deduction against your net income, so you don't have to pay corporation income tax. Now that we wrap up all the differences between salary versus dividend, you now understand why it is so complicated to actually give you a straight answer. Should you pay yourself dividend or salary? We really need to go through all these questions, like, do you have young kids? Do you have childcare expenses? Who are you paying salary to? Who are you paying dividend to? How much money you need? All these questions before we can decide whether it is more beneficial to pay you dividend or salary. If you find this video useful, it is very difficult to organize all this information together. And if you find the video useful, make sure that you give us a thumbs up and then subscribe to our YouTube channel to stay on top of the latest tax tips, as well as any expert advice on how to get to financial freedom. Until next time, happy Canadian real estate investing.